So we certainly think that if you look at cross-commodity correlations, those have been falling, which sort of points to we now really have to focus on the the micro trends within each commodity, and we think that it'll be down to the individual commodity fundamentals which will start to drive either underperformance or outperformance.
We all like a winner, so let's start with the outperformers that you see over the next 12 to 24 months. Gold, silver, nickel and uranium are meant to be the winners. Start with gold, because we've got an environment where the Fed's likely to be hiking still, winding down its balance sheet. We may see some action from the ECB. Why is that scenario going to be positive for gold? Because everybody would expect it would be the opposite.
No, certainly, look, I certainly think that gold may come under pressure in the very, very near term, but those forecasts were slightly longer term based, so over the 12 to 24 month basis. And I think once we get through the Fed hike, gold starts to look a lot better, because that's already being, that'll be priced in already.
You may get through the Fed hike, but there's meant to be a series of follow-up hikes in 2018.
Sure, indeed there is. And I think it's more just about the expectation of how many that are going to come through. And our view is, I think we've pushed up our estimates for at least 2 for next year.
I want to go back to the original answer you gave to Karen, actually, if I may, and why I mean, of course we always have to look at individual fundamentals of every individual stock or every individual asset class or every individual commodity. But I would have thought, given what we heard from the IMF yesterday and given what we're thinking now about a new cycle beginning, that actually a rising tide would float all boats. So owning a commodity fund or owning a basket of commodities, I would have thought that would have worked at a time when we think that global growth is picking up, rather than having to nitpick over the individuals.
That's a fair point. I think for us it boils down to China. So okay, we do feel the Chinese economy is, let's say, at the point of maximum momentum.
And really? Okay,
yes,
that's interesting.
So we do feel that next year the growth rates will start to slow a little bit. So still growth, yeah, but it'll definitely start to slow.
Okay, so on that question, what is it that China's using a lot of that you think is going to be accelerated, and what is it that China doesn't need so much of? And may I direct you to ask you within that about copper?
Sure. So China's still going to be using a lot of steel, which is going to be positive for iron ore, but that'll slow down for next year. So we think iron ore demand will probably be flat or slightly down for next year. Certainly copper is one of the more positive ones, so that's a slightly later cycle commodity. So we're certainly more positive on copper, but probably over the medium term. So for next year, the story about copper is we have a supply response that's coming back. So there's a few more mines that are being started for next year, which we think pushes the market into a little bit of oversupply. Of course, the EV story, the electric vehicle story, yes, starts to come into play, but that's more of a longer term story, and probably won't influence the supply-demand dynamics for next year.